Hi everyone and welcome to the first market update from Seven Financial Planning. We are hoping to do these more regularly, and the aim is just to give you some more information and say a quick insight into what is happening around the world, especially world markets, and how they are affecting your pensions and your investments. Remember, we're here to give you peace of mind. We believe in our investment strategies are the right ones for you and continue to be the right ones for you. We believe in the financial planning that we do, and anything that it might be concerning to you, or you might read something, you might watch something on the news and you think, oh, that doesn't sound too good, just drop us a message. We're always happy to help. So let's get into it then. 2022 reasons to be optimistic. 2022 has, in terms of investment markets, has started quite volatile, and I think things will be a little bit shaky. I'm not gonna say everything's going to be rosy when I just don't think the way the world is at the moment it will be. But like I was saying, we do believe in our investment strategies. We do believe in our portfolios and funds and what we've got, and so there is reason for optimism. When I said 2022 will be a shaky year, the main reasons for that is, and I'm sure you've heard in the news, inflation, Russia and Ukraine. They are quite two massively different subjects in their own right, and we will come on to about more of those later on. But there is still reasons why we think you should be optimistic. The economy is flying. The economy has absolutely, absolutely went crazy, and so to speak. But there's been that much money pumped into the economy, given to people, given to businesses, since the course of the pandemic, that people have saved more as well. So now people are going out spending more. I'm sure when you go to a petrol station, when you've been to a supermarket, your gas, electric, everything has gone up. Everyone can see, everyone knows that the prices have went up. Employment is high and wages are rising. So they're three pretty good things. And in terms of investments, if we just look at certain sort of markets and things, the S&P, which is an American stock market, is absolutely accelerated. Of course, it's been bumpy along the way, but has really done fantastically well last year. It has hit some highs this month. It was only last year that Apple hit the $3 trillion mark, which is just absolutely crazy. I think it hit 1 trillion in 2018, and so that acceleration of growth, which we will continue to see with tech stocks, and with companies like that, will continue to happen. So if you continue to invest into these good, well-structured, massive companies, you've still got optimism for growth. And so that's what it's why we are quite positive. All of our portfolios are centralised around our key element, and that is diversification. Looking ahead, so inflation, there's billions of pounds being pumped into our economy and industries, and the lessening of restrictions have meant that things have opened up. People are going out spending more, and whilst I, for one, am glad that there is some normality happening again, bills are going up, and it's everywhere. It's not just in the UK, Europe, America. The Fed are probably going to introduce some changes in the interest rate to try and combat that. The Bank of England rose interest rates to 0.25% last year, December, and there's talks of them rising them again, as that has always been sort of the go-to to combat inflation. But the best way to protect, you might be thinking, well, what am I supposed to do with my pension, with my investment, is by investing in the right asset classes. So what protects against inflation? My always go-to is equities, good, strong companies that will grow, give you growth that is higher than inflation. And there are certainly companies out there that will do that this year. Commodities was the best performing asset class last year. Commodities are raw materials, base raw materials, and so they outperformed everything last year alongside REITs. REITs are a type of property, and so again, property is a inflation usually beating asset class. So if you have a portfolio that is positioned well in those areas, I think, we should combat the risk of inflation and hopefully still see growth on portfolios. Russia and Ukraine is the next sort of the big sort of what do I look out for? What is going to cause markets concern, people concern, and it's obviously what is happening over there. In the Middle East, anything that sort of any conflict around the world, wherever it may be, especially in the Middle East, will cause concern because there's always the risk that oil prices will absolutely jump through the roof, and that markets don't like that. We've seen that in recent times, and so hopefully, we see things calm down a little bit. If America and other countries do sort of threaten, if you like, because I don't think Putin would like to be threatened. But if he knows that there's going to be heavy sanctions on Russia, he might back off a bit. The honest answer is we don't know what's going to happen with that situation. It is extremely volatile, and it's something that we are going to keep our eye on going forward, and hopefully, things settle down. Markets don't like conflict, and if there was sort of escalations over there, you will see markets fall. So the next few slides that will come up is more about what investments you have, and markets. So this graph is showing you the S&P 500 and the FTSE 100 and the MSCI World GTR. Now, the S&P 500 is the American stock market of the largest 500 companies, and I think I touched upon this right at the beginning. As absolutely, last year it hit record highs. As you can see, it's jittery, it bounces, it goes up and down. But the main point, and what all these graphs will show you, if you look at the starting point to where you are now, you are in a better position. And like I say, the stock markets are the S&P 500 and the FTSE 100 are primarily stocks and shares. They're the most risky market or asset class that you can have. So the jumps that you see there are quite substantial, and you might think are a bit scary, but over the past year there has been some very good growth. The next slide is showing you the Royal London Fund. So a lot of you have money invested in the government portfolios and the government retirement income portfolios. The government portfolios are for people not at retirement yet, so pre-retirement. The group funds, we like to call them, a shorter version, for people in retirement, so people taking a income from their pensions. These are specifically designed for those people. The government portfolio is specifically designed for people wanting to accumulate growth. Royal London we still think is a good provider. We still really like, as you can see by the graph, there's been some jittery performance, but overall we still think that these portfolios are very good. Trevor Greetham is the fund manager there. We think, he is a very good fund manager, and his updates are keep us in the loop of what's going on. And so we still think that these are appropriate for a lot of people. I mean, as you can see, February 2020, when the world was basically ending, everything, you might think, wow, it dropped that much, but everything dropped higher than these portfolios because these are more risk managed. But again, look at zero, look from where we started 5 years ago to now, you have made money, and the people who have also took money out are still in a good position with the capital on their pension as well. So we still think that these are good funds to have. The HSBC Global Strategy Funds, a multi-asset fund. Again, we love multi-asset funds. Diversification is key to our investment strategy. Something that it has to be paramount to any investment strategy, I think, to really have all those different asset classes that will give different risks, different returns. The global strategy funds have performed again very well. If you look at the starting point and to where the graph goes to now, you've made some nice returns there. You can see the dips along the way. Obviously, the pandemic caused massive jitters. The stock market crashed. The stock market has recovered in remarkable time. In a remarkable time. I don't think anybody expected it to recover so quick, but it has. So we I know a lot of people are invested in these funds, and again, just showing you the performance on there of how these have done, and we think they are still appropriate for a lot of people. The L&G multi-index fund, again, another multi-index fund, quite similar in terms of strategies and diversification to the HSBC funds. What we like to do with the L&G funds is blend them with the HSBC to give maximum diversification. But you can see there again, great performance, and it's similar to the HSBC funds. The L&G have really low annual management charges. So low annual management charges, great performance, good diversification. You know, it's all a recipe for a good fund. That is a brief update on how the funds have done over 5 years. We hope that you are still as confident in them as we are. Like I say, we have no sort of worries with them at the moment. We still think that they're really good for a lot of people. We hope you found that informative. If there's any questions, please do get in touch. If you haven't already, please head over to our new website, 7financialplanning.co.uk. As many as you probably know now, we've got brand new look, brand new trading name, brand new website. We think it looks really good, very modern, very sleek, and we hope you all like it. If there's any feedback, good or bad, please do get in touch.